Welcome back, focused learners, to another explainer. Today, we're taking what might honestly seem like a pretty dry accounting topic, the life cycle of inventory, and turning it into an actual story. We're going to decode these 16 separate journal entries and see how they seamlessly form the fascinating journey of a product, literally from the moment you order raw materials all the way to the cash register.
Okay, let's dive into this. If you've ever stared at a balance sheet, you might have wondered to yourself, why on earth does inventory generate more journal entries than any other asset? Well, the reason is completely structural. Every single physical movement of inventory out there on the warehouse floor has a corresponding general ledger entry. It leaves a definitive paper trail at every single step.
To actually make sense of all these entries, we really have to grasp the governing principle here. Basically, inventory is fiercely protected as an asset on your books until it meets one of three ultimate fates. Number one, it gets sold, right? And its cost finally moves to cost of goods sold, or COGS. Number two, it gets lost or damaged, which means it becomes an immediate expense. Or number three, its value actually drops below what you paid for it, meaning it absolutely has to be written down to its net realizable value, or NRV. Oh, and a quick side note here, standard cost variances are always recorded as separate entries at period end. They're entirely distinct from the actual physical movement of the goods.
So, 16 entries definitely sounds like an overwhelming amount, but don't worry, they actually fit perfectly into a really neat chronological 5-step framework. We're going to quickly walk through inflow and capitalization, production accumulation, completion and sale, variances and disposition, and finally, losses and adjustments. See? Pretty manageable.
All right, Phase 1, Inflow and Capitalization. This covers entries 1 and 2. This is where the hero's journey of our inventory really begins, figuring out how goods first get onto the books at their true cost.
Entry 1 is all about recording the purchase at landed cost. And landed cost is essentially the foundation for accurate capitalization. It's not just the invoice price of those raw materials, it actually includes all capitalizable components required to get that inventory ready for use. We're talking the purchase price, plus duties, freight, and insurance. When those raw materials arrive, you debit raw materials inventory for that full amount and credit accounts payable.
Now, for entry 2, which deals with incremental import duties and landed costs, we need to be incredibly careful. Watch out here. Seriously. If you expense your duties, freight, or insurance right away instead of properly capitalizing them into your raw materials inventory, you are severely understating your inventory asset. Worse than that, you're distorting your profit margins right from the very start of the life cycle. You absolutely have to debit the inventory for these incremental costs to get the true accurate picture.
Okay, moving right along to Phase 2, Production Accumulation, covering entries 3 through 6. This is the transformation phase, where our product actually gets built on the factory floor. Let's walk through how these costs build up step by step. First, in entry 3, raw materials are officially issued to production. We debit work in process, or WIP, inventory, based on the standard cost from the bill of materials. Next up is entry 4, where direct labor gets applied. We debit WIP for the standard hours worked at the standard rate. And finally, we have to account for overhead in entries 5 and 6, basically using our predetermined overhead rate to allocate indirect costs, like rent and factory utilities, straight into the product.
Now, what's really interesting about this slide is the whole concept of a holding pen. When you record entry 5 for actual overhead incurred, your manufacturing overhead control account acts as this temporary holding pen for your actual cash spend on things like factory rent. But in entry 6, when you apply that overhead to WIP, you are essentially pushing an estimate into the product cost. And because reality rarely perfectly matches our estimates, these two numbers almost never match, which creates an over- or under-applied balance that we're going to have to deal with a bit later.
Phase 3, Completion and Sale, entries 7 and 8. This is the absolute climax of our inventory's journey as it moves out of production and heads straight towards the customer.
In entry 7, the physical batch is finally complete. We transfer the goods by debiting finished goods inventory for the cost of goods manufactured, and we credit work in process, officially clearing it right off the factory floor. Then comes entry 8, the ultimate destination. At the exact point of sale, we debit cost of goods sold and credit finished goods, ringing it up at the register.
This right here is a massive narrative pivot in our accounting story. Entry 8 is the exact moment, the very second a balance sheet item, an asset we have been so carefully building and tracking, transforms into an income statement expense. It's a beautiful thing, perfectly matched against the revenue it just earned for the business.
Phase 4, Variances and Disposition, entries 9 through 11.
We're entering the reality check phase, where our theoretical standard costs meet the sometimes harsh reality of actual business operations.
Because materials and labor were recorded at standard costs earlier in the process, any gap between our standard expectation and our actual, real-world spend becomes a variance. For instance, Entry 9 handles the material price variance, like, say, if raw materials suddenly cost way more than expected, and Entry 10 handles material usage variance at period end, literally removing excess standard costs from WIP if we happen to use more materials than the recipe actually called for.
And then we absolutely must address Entry 11, overhead variance disposition. If the variance between our estimated overhead and actual spend is just a small amount, we just close it out to COGS. But watch out, if that variance is material, meaning it's significant, closing it entirely to COGS completely distorts your balance sheet. Why? Well, because part of that actual cost belongs to inventory that is literally still sitting on your shelves. You have to allocate a material variance proportionally across COGS, WIP, and finished goods inventory, rather than just dumping it all into one single account.
Finally, Phase 5, Losses and Adjustments. Entries 12 through 16. This is the final phase to keep the inventory totally honest by routing lost value and recognizing legal title. Let's take a look at spoilage. Entry 12 is actually a bit of a trick question. There is no separate journal entry for normal spoilage. Because it's expected, it's already absorbed right into the standard cost per unit of the good output. But Entry 13 tackles abnormal spoilage. Say, a forklift backs into a machine and destroys a whole batch. That is not part of product cost. You must debit abnormal spoilage loss as a period expense and get it out of WIP immediately. The final 3 entries are our period and reality checks. First up, Entry 14 writes down inventory if the market value drops below cost, which, by the way, is handled slightly differently depending on whether you're using IFRS or GAAP. Next, we have Entry 15, which records shrinkage if your physical warehouse count is lower than what the books actually say. Theft, loss, things like that. And finally, Entry 16 ensures goods in transit are recorded on your books if the legal title has officially passed to you, even if those goods haven't physically arrived at the warehouse yet.
So, the crucial point is this. When making adjustments, only expected, unavoidable loss belongs in the cost of your product. Everything else hits the income statement immediately as an expense. Furthermore, legal title, not physical location, always determines the ownership of goods. That's a really important rule to remember.
And this summary blueprint right here brilliantly illustrates the entire journey we just took. We took 16 completely disparate, highly technical journal entries and formed one logical, incredibly cohesive lifecycle story. We capitalized the full landed cost, we built the product in WIP, we transformed the asset into an expense at the point of sale, we reconciled our theoretical estimates with actual reality, and finally, we adjusted for losses in title. It really is a perfect system when you see it all laid out like this.
Which brings us to the very end of our explainer today. I really want you to take a hard look at your own real-world accounting processes through this 5-cluster framework. Where are the gaps? Are you expensing free too early? Are you just dumping material variances straight into COGS? Ask yourself right now, what part of your inventory lifecycle is hiding the most margin distortion? Really think about it, audit your systems, and as always, keep learning. Thanks so much for joining me on this explainer, and I'll catch you next time.